All right, great. Good morning, everyone. I apologize. I got late this morning, but I appreciate I'm glad I could make it on time. This morning, first I'd like to introduce myself real quick. My name is Parag Nevatia, and I recently joined IFPG about a month and a half ago. Who we are is basically we're a certified SBA certified advisory and project finance company. We act like a support system to the SBA financing industry. We do loan processing from start to the closing table. We do project finance, risk analysis, turnaround consulting, and business sustainability and advisory, which basically means how do you sustain the growth of a business, whether it's a startup or whether it's an existing business, how do you support and maintain its sustainability. So we'll kind of go through a few of these things later on, but we conduct seminars, webinars such as this, counseling services. We underwrite loan projects. That's one of the biggest pieces that we bring to any franchise or any business is really we underwrite loan projects, risk, and find the right mitigants to the risks so that it improves and gives the highest probability of approval when a project goes into a bank. It's not a loan package, but it has to be a viable loan project that will get approved. We control once the project is approved, we jump right back in and take control of the closing processes of the finance so that we can take our client to the closing table quickly. So what's our vision and our mission? We ensure bankability in any project when a client is looking for financing. We speed up loan processes and bring common sense, analytical common sense to the sales-oriented banking system. We work on the pain points at every stage of the process to eliminate or mitigate risk by finding, like I said, legal and compliant solutions. When I say compliant, I mean SBA compliant. And we help the business community secure financing with a former banker on their side. So which brings me to the next slide of who am I. So I come with 20 years of former banking experience, and I was at 7 different banks over 20 years. Today, I'm certified by SBA by NAGL, and I'm an advisor, a counselor at the SPDC. I've done a seminar for SCORE as well, and I own this company called Easy Funding Solutions. I'm not going to go through a lot of this, but I'm going to skip through real quick to the content. So franchising facts. I gathered this information. 55% of all Americans want to be their own boss. 1 out of 25 adults is currently starting a business. There are over 900 franchise businesses in the US providing 21 million jobs. There are over 3,000 franchising concepts in over 90 different categories. So what is a franchise model? Why does somebody get into a business? Why does somebody not start a new business, their own business, as opposed to jumping into a franchise model? Because it's a preset and a proven model to follow. Majority costs are known and controlled. The benefit of using a known name, which is the royalty, eases the marketing effort and cost. And customers know what to expect. I travel and I go to a different state. My son plays baseball, so when we're traveling, you want to go into something that you're familiar with because you know what to expect from quality standpoint. So that's one big benefit of a franchising model. You get support from franchise when something isn't working, right? You don't have to recreate technology to run an operation because the franchise provides you the right technology. So who is your average franchisee? Somebody who's looking to start a business with less risk, has limited resources, has limited capital to invest. They are reluctant. They are new entrepreneurs. They don't know. That's why they're looking at a franchise model to get some support. they may or may not have some relative experience in the industry. And that's one of the very important key aspects that I deal with as a consulting company. Um, SBA changed its regulations a couple of years ago where they didn't want the owner just to have the experience, or maybe the owner is just an investor and has a manager to run the business. Well, the problem with that came up when managers got a better job. They left the business and left basically the business completely out dry, in the middle of the lake with no oar to paddle back home. So it's important for manager to be given some kind of a minority ownership if you want a bank to be able to lend the money, basically to see how we can help franchisees be bankable. And the last point over here is your average franchisee needs some financing. Either they get some support from the franchise sends them to a bank, which is the bank financing. So who lends? Who are the lenders that lend money out there? I'm just quickly going to go through this. There are traditional lenders and non-traditional lenders. For the sake of this webinar, there are those asterisks that you see, the blue asterisks. There are regional banks, community banks, and non-bank lenders. Me being a former banker myself, having worked for banks like HSBC, PNC Bank, NatWest, which is now Bank of America, Wachovia Bank, which is now Wells Fargo, and then you have the community banks. You have regional banks like the Bank of Americas and the PNC banks and the TD banks, and then you have the non-bank lenders that are BMC Capitals, the Q2 Capitals, who are not actually banks, but they are SBA lenders. You have some credit unions that have started kind of getting the feet wet within the SBA arena. Not too many of them. We're not going to focus too much on the non-traditional lenders, but just wanted to throw this out that there are non-traditional lenders like the merchant lenders, the credit card lenders, hard money lenders, and private equity. What are the types of financing that are available? So you have traditional loans and SBA loans. Again, for the sake of this exercise, this webinar, I'm going to stress on the SBA loans. Now, financing is dependent on the type of business, the use of the money, how you will pay back the money, which is cash flow, and if there is collateral or not. Who are your customers? Do you have a model, revenue model? Do you have a plan? How strong is the plan? Do you have the assumptions? And do the assumptions make sense? Just jumping in to the previous, since we're focusing more towards how we can make your franchisees bankable is the topic of this webinar. I want to put some focus on the SBA opportunity. There's quite some unknown information out there about the SBA, and I wanted to just kind of put some thought into this. The SBA was basically is a federal program that was formed in 1953 to help small businesses grow in the U.S. When we were faced with the worst recession in 2008, obviously we all know that it led banks to stop lending money because they just froze pretty much. At that point, SBA had to encourage banks to keep lending, especially to those businesses that were bankable. And again, we keep talking about the word bankable, and we'll get to that a few slides later. The program was implemented as a simulation to maintain and pick up US's the nation's economy, create new jobs. That's one of the biggest criteria of SBA. They want to make sure that they're creating new jobs and economy is growing. Some more facts: SBA does not make loans. SBA basically makes loans through banks, but what it does is provides bank with a guarantee as an insurance that if the loan fails, they will come and audit the file, and if they do not find mistakes, they will back up the bank up to 75% of the loan amount. But the question was, if they don't, the point was if they don't find mistakes in underwriting. However, many banks in the past, I'm not going to name the banks, but many banks in the past who don't do SBA anymore um, basically did have some problems with the underwriting, and that's the reason why the Fed went in and shut them down. Um, the last fact about SBA, obviously, it's got lower payments, longer terms, and loosened criteria to allow the growth. Usually on loans without real estate, it's a 10-year amortization, and loans with real estate is 25-year amortization. Some most common business loan programs, 7A, 504, and commercial loans. I'm not going to go through the details on this. Again, I'm just going to kind of bring it up. There's 7A is the most prevalent SBA program out there. Um, and what I'd like to throw out is why 7A. It allows mitigants to certain risks, and it allows lack of collateral, lack of cash flow with a story of turnaround, lack of credit perhaps that can be explained. I mentioned relative experience. It's one of the key factors to go to a bank to be bankable. Some owner's equity in terms of down payment and a piece of the seller note that comes in. Just wanted to share some interesting numbers over here. 2016, SBA guaranteed $24.1 billion in loans in a total of 64,000 loans. Now, if you really go back to 2011, that 24 was 19.6 billion annual. SBA fiscal year starts October 1st and September 30th every year. So very interesting facts. If you look at loans between 150 to 350, you can see only 2.7 under 2016, only 2.7 out of 24 billion are in the range of 150 to 350. Most loans are in that, the sweet spot I would say is between 350 and $2 million. We got 11.3 billion, which is almost about 45% of 24 or more probably. So what does bankability mean? What does bankability depend on? It really depends on 5 C's of collateral, and I think the audience over here really, the franchise brokers over here really want to make sure that you understand when you look at a client, when you look at a prospect, you want to think of these 5 key features. You want to think about if they have credit in terms, credit is basically what results in what banks look at as character. If there's a pattern of not making payments, that's a problem. That's a flag within the bank. It's a moral obligation. What banks look at is it's a moral obligation for each individual to keep making payments on time to a creditor. If not, the new creditor has a problem with it. So you really want to kind of ask that question, and if it's below 700, you really want to take a look at it and perhaps guide them to somebody who can evaluate their credit score and see if they can help. The next is cash flow. Everybody knows cash flow is king. If you don't have the ability to pay back a loan, how are you gonna be bankable? That's one of the very important pieces of 5 C's. Capital. So how financially committed is that franchisee, the borrower, with their own money? Do they have some money that they bring to the table? Yes, there's a seller note that will help them fill in the gap, but they need to bring some kind of equity of their own. The regulation on down payment usually is about 10% of the down payment should really come from the borrower's equity. It could be form of a gift as well. The 4th C is conditions. Which is very general. It talks about if the conditions of the business, the location is conducive to that kind of a business model. What kind of industry are they in? Are they in the right type of industry at that given point in the economy? Experience, again, you've heard me say experience a few different times. And can the business really survive in national and economic downturns like we've seen the recession? And the last C that I mentioned is collateral. And the reason why I mention it last is simply because SBA 7A programs actually do allow banks that follow the SBA guidelines to be able to approve loans without collateral. Just to throw a couple of examples, we have a $3.5 million medical billing acquisition project right now in New York, and there is no real estate collateral whatsoever. The borrower probably has about $200,000 in equity in their home, if that. Yes, there are, the cash flow is extremely strong. The credit is strong as well, over 700. And they've been in business for 18 years. The seller's been in business, so the type of industry, the experience, the seller's going to stay back and support the client for the first 12 months after the change of hands. So a lot of the other C's of risk are mitigated for the lack of collateral in this project. So what do lenders want to see to make franchisees bankable is really what it comes down to. They'd like to see strong personal financials. They'd like to look at the experience. Probably said it the fifth time in this webinar. Experience is really key in this day and age. I have a client real quick. Have a client who's looking to buy a restaurant, is going to be an absentee owner, is going to be at the restaurant only after 7 o'clock in the evening, and it's a problem. One of the reasons why I'm not encouraging this client to even start thinking about buying this business is because she simply doesn't have the ability to, she has no experience in the relative industry, and she's going to be there at 7 o'clock. Not going to work. Banks are not going to look at it favorably at all. And then they want to see the ability to pay back, cash flow, right? The projections have to be believable. The historical cash flow has to be profitable. And if it's not, you got to have some good explanation as to why the numbers are not profitable. Detailed breakdown of budget and franchise costs. So, when a franchisor gives the budget and whether there's construction involved or not, banks really require, in the use of proceeds, they require a detailed breakdown of the budget, including franchise costs, construction, working capital, inventory, etc., etc. It needs to be broken down. And one of the other important points is strong financial statistic of franchise. Your FDD usually has a lot of this information, and this is something, preliminary information that makes a franchisee bankable. If you can get all these pieces together, that's a very good place to start. So comes down to why somebody like us, we are, like I said, we are a certified SBA loan advisory and a project finance company. We have former banking experience and relationships, former banker relationships to convince them to approve loans. We know which bank favors which industry and which franchise. We know the lending capacity of banks. Each bank has their capacity that goes up and down over time. We find legal and compliance solutions to risks. This is probably one of the key, the next two items are probably one of the key areas that we focus on. On a loan opportunity or a project, and I'm not using the word package, is we find legal and SBA compliance solutions to the risks in that project. We underwrite loan projects before a bank underwrites them. This way we ensure the bankability and the approval as well as chance of approval. We ease the process right from beginning to the end through focusing on clarity, speed, and accountability. We hold clients' hands basically from the concept, the idea, the thought process to underwriting, convincing banks, and getting into the closing due diligence stage to coordinate weekly phone calls to be held accountable for the closing process as well, to taking the client to the closing table. We get projects approved and closed quickly. That is basically what we provide. So with that, I think I'm done with my time. Here's my contacts. If anyone is looking for any, if you'd like a copy of this presentation, please let Rachel know, and hopefully, she'll be able to send it out to you. If not, you can reach out to me directly as well, and I'll be able to help. Rachel, that's pretty much it. Thank you so much.
Perfect. Okay, does anybody have any questions at this time? You can type it in the question box or take yourself off mute.
Hey, this is Jared. I just wanted to mention as well that I'm happy to provide this presentation to any of the brokers who wanted to, they themselves present it to any potential franchisees that they had. I'm more than happy to do that step for them as well, but I can definitely make this available.
Perfect. Any questions? Let me make sure everyone's off mute. Oh, Joel, I see you have your hand up. One moment, I'm just going to try to unmute you. Okay, Joel, you are
Hey.
unmuted, so if you have a question.
Yeah, my question was, how much does having a felony impact the ability for someone to get an SBA loan? Like, for an example, if someone was a teenager and got tried as an adult and was a felony, and now they're, years and years later, and they turn their life around and are doing good, how much does that impact their ability to get a loan?
Um, Great question. Rachel, am I on?
Yes, we can hear you.
Okay, great question. In my banking experience, I have had probably two situations where there was a client who um, had a problem, and he just to it's not an SBA's problem. More, it's more of the first level is the bank. The bank usually would have a problem to look at that client as a borrower, as a potential borrower of the bank. You've got to find mitigants to that situation. Now, if you can explain, literally when I say explain, it's got to be handwritten down or typed down at least one page, not too much, but just what happened, when it happened. And I've been able to successfully actually go back, and the third paragraph says, the client's got 3 kids, married, XYZ, has a job, things happen. Um, it's a 50-50 kind of an answer to your question. It depends again on the bank. If you can convince the bank. Now, one of the biggest things is, we can because I've been that banker, I can look at a situation and assess how much of the seriousness of that situation was. And one other important thing that banks look for is did that person serve time? Um, so again, it depends on the situation. If we can delicately put it on paper, explain what has transitioned over from that point to years later, and the person has been responsible of handling a life or lives of people, and makes money and is back, is doing things. You know what? You'll be surprised. There might be a way to get it done, but it's a um, tougher situation to kind of get a solution to. It's not that easy, as you may know. But there are banks that who, if they abide by the SBA regs and they know that SBA gives people the chance to explain, then you should be fine. But it's always trying to find the right bank, the right fit, who's compassionate and understands what happened, and it could have been many years ago. So if you can scale it out and show that the individual has been responsible enough for their duties and responsibilities, then I think you have a good shot. I know that answers completely. Was that helpful?
Joel, I see yourself
Yes,
mute.
thank
There you
you.
go. Perfect.
That was very helpful. I guess my other question is, what role does credit score play in getting SBA loans? Does it have
I
to
had
be above 700, or are there allotments or?
Yes, I'll answer that question maybe two or three different ways. Live demonstration of a client coming to us about a year ago, 570 credit score, had some late payments on credit reports, um, no collateral, and it was a negative EBITDA on tax returns, negative cash flow on tax returns. We still got them in approval. How we got them in approval is we went to the right bank. We convinced the bank that, listen, um, he's the reason why the debt is so high and the credit score is low is because debt to income ratio. Mind you, the individual was making about $150,000 a year. So there's, probably not too much reason to believe that he was not able to handle his debt correctly, but we were able to convince a bank to approve the loan with some mitigants. And one of the biggest mitigants in that situation was his wife had a 760 credit score, and she came in as a full guarantor as opposed to a limited guarantor to the loan. So that was one big mitigant. If we can kind of take the mind of the banker away from, the issues around the credit that cause the credit score to be where it is, and of course by um, refinancing a lot of the debt that we were financing, we would pay back the personal credit cards, which would invariably help him increase his credit score 3 months, 4 months down the road. So if you have that kind of a mix in a situation which helps his personal credit scores to kind of go up as a result of lending him that money, but keeping it tight and accountable, then that's the way to do it. So to answer your question in short is, I said less than 700, anything between 650 and 700 is usually a debt to income situation. Anything below 650 is usually they're not able to make payments at all. And each of those situations have to be explained delicately. Again, I review credit reports every day. I review what's going on. We can refer, you can go to a credit restoration company out there, and we have a live example of that. A client who came in for financing had a 628 credit score, and I knew a bank is not going to have, they're going to have a problem looking at that project. We waited 3 months later, her credit score went up to 698. The lowest credit score was 698 in 3 months. So you got to, I think the first step is to really look at what the reasons are behind why the credit score is that low, and see if you can mitigate it. And if you cannot find a quick fix to it, then it's probably better off to take 3-4 months to try and fix it and then go back to a bank, because you're not ready. You're not kind of completely bankable at that stage when the credit score is below 650.
Thank you.
Is that good enough? Sure.
Yeah, that's good.
Okay, great. Does anybody have any last minute questions? Okay, well, thank you everybody for joining the call today. Enjoy the rest of your day, everyone.
Thank
Great,
you.
guys. Thank you
Have a
so much,
good one.
Rachel. Have a great day. Bye-bye.